slightly smaller and intimate gathering this afternoon for our final session, everyone. Well done to you, because you've got a great speaker coming up on stage. Cazaly is first up. Before we do that, just was having a chat with my mate Tom from GEO. Stick your hand up. He's a geologist. Don't hold that against him. But I was just saying, I'd forgotten all about all the little, the goodies that we can get as we walk around outside. I did see when I first came in the gold bars. Who's got gold bars of chocolate? Anyone? Yep. Anyone got the chocolate yet? Put your hand up. How many have you got? Just the one, have you? Just the one. Who else has got a gold bar? Anyone? How many do you have? One. You're very good. We're going to ask our next speaker a question about those gold bars in a minute. But Thomas said that all of his GEO pens, if you are after a GEO pen, no luck. They've gone. There's someone with a small pen emporium out there, or everyone wants a GEO pen. Who's got their, did anyone get a GEO pen? And what was so special about it? Let's say, just while I'm waiting, what pens did you get, sir? You've got a couple of them there. Is yours a GEO pen, David? No? What have you got pens from?
Consultant? Hyatt and Mineral Consultants.
What's the other pen? Is that your own special one?
That's Hyatt Regency, Sydney.
Right one, so you're a pen collector too. Fabulous. We'll be checking you all, Christopher, over the days as they go, see how many pens you get. Is my next speaker in the room with me now? Ms. French, you are. Fantastic. Okay, let's get this session started. And at the end, I'd love for you all to stay with us because we've got drinks in the gold bar as well. So lots to catch up on today. All right, Cazaly Resources. I can tell you one thing, they've got a lot of upside in them. They've got a market cap of 14.5 million. They've got a healthy cash and investment position, $13 million. Now that means that they are really well placed to make new discoveries with very enviable exploration tenure in WA and also over in Namibia. This is Tara French, and before Tara, before you do take to the microphone, can I just borrow you for 1 second away from there? Tara is the Managing Director. Tell me, Tara, how many gold bars do you have?
None from here, unfortunately. No chocolate ones. I've got a couple at home, though. A couple of real ones.
Okay, that's all right then. Okay, would you please make a welcome today as you join us on stage for our first speaker, last session of the day, Day 1, 2022, Ms. Tara French.
Thanks, everybody. Appreciate your time today. Now, I've only got 15 minutes, so this is going to be a really quick fly-through overview, if you like. So please feel free to come and see me in the booth afterwards. The location of our project. So this just shows where we're working, predominantly in WA at the moment, and we've also got a project in Southern Africa, in Namibia. I'm just going to dive straight into it because otherwise I'll run out of time. So our Halls Creek project, this is an exciting copper project. We've recently acquired this ground back. It was previously in a joint venture, so Cazaly now own this 100%. Since acquisition in 2020, we've done a lot of field work, so on-ground mapping, some geochemical sampling, ground magnetics, EM surveys. We've also upgraded the resource to 2012 JORC compliance. The resource at Mount Angelo stands at 1.7 million tonnes, 1.4% copper, the same zinc, and 12 grams per tonne silver. So today I just want to give you a bit of an update on the projects you can see on screen. See if I can get this thing going. So Mount Angelo, this is where the resource sits. I'll be talking today about the Bommy prospect and the Moses Rock target. So these are our EM drill targets to date. You see the one at the top there, which is the extension of the Mount Angelo copper zinc silver deposit. We're pretty sure this is a down plunge extension. I mean, we've got pretty amazing intercepts at that deposit, 64 metres at 2.7% copper, 37 metres at 6.1% zinc. That is, however, a single line anomaly, so we'll probably be doing some more EM work there before we actually drill test that one. The Moses Rock conductor, which is located just about 2 kilometres to the southwest. That's a robust conductor, it's well defined. I'm looking forward to getting the rig out there and testing that one. That'll be tested with RC drilling later this month. The Bommy prospect. So this is quite a large target actually. This is the surface expression. So this is surface geochem, what you're looking at there at surface. Multi-element anomaly, copper, zinc, bismuth and moly. It's about 1 kilometre long, almost 800 metres wide. There's some drilling by Cazaly that was done in the past, which has turned up some pretty amazing intercepts, 170 metres at 0.4. So it's a low-grade system. We have done a little bit of work at the geochem, so we've vectored in towards some high-grade zones, which we're hoping to intersect in this next phase of drilling. Now, we just recently completed the heritage survey. It was 6 months in the making, so we're very glad to get that completed. And waiting on the report for that, we've got a rig booked, and we intend to start drilling later this month. Into the Ashburton Gold Project. Cazaly pegged this ground just before I started with the company, actually. It's a massive land holding, very impressive land tenure, 2,500 square kilometres, located, as you can see there, between Paulson's and Mount Olympus. Since the guys pegged this ground, they've done quite a bit of work, desktop studies, before we could actually get on the ground. A lot of target generation. We had PGN consultants assess all of the stratigraphy, all of the big data sets that we had, including magnetotellurics, seismic surveys, etc. So they pulled it all together for us. And it was really interesting. Besides these two mantle tapping structures that you see there, the Nandragati, which is very well known, the Bearing Downs fault, they also identified 2 more, which run straight through our tenure. So we're pretty excited about it. We all know these mantle tapping structures are pathways for mineralised fluids, which is why it provides so much potential for discovery out there. Since the grant in October, we've completed quite a bit of field work already. Keep in mind, this is a greenfields play, so we do have a lot of groundwork to do before we can actually generate drill targets for drill testing. So we've collected over 1,200 surface samples, the majority being streams and soils. From these, we've already generated anomalous results, gold and base metals. These trends are quite extensive. You can see they're 50 kilometres long there. The other thing that is quite encouraging is that they do also line up with these mantle tapping structures. So early days, but so far so good. We also tested some conceptual targets with soils. And so what we got there was anomalous results at Ramhole Creek, Warden Pool and New Finish. I won't go into too much detail here, but the idea is to just show you the scale of the targets we're looking at here. So they're all kilometre scale targets. We're looking for a big deposit out there. And so we're aiming to do enough work towards the end of this year, complete the rest of the surface sampling across the remainder of the tenements and any infill we need to do in order to generate some drill targets, which would aim to test late this year, more than likely next year. It's our Yabby Gold Project. The Yabby Gold Project is located in the Laverton Greenstone Belt. Very prospective. You can see the location there, just 10 kilometres to the west of Laverton. It's about 16 square kilometres. Prospective for nickel and gold. However, first pass geochemical sampling shows that it's most prospective for gold, so that's what we'll be following up with. So what we've identified, this is quite core-spaced sampling anyway, 400 metres by 200, and we've identified kilometre scale gold mineralised trends. We'll be infilling that before we can generate drill targets, and that'll be happening in the next couple of months. We're in good company there as well. We know there's no mineralisation to the south of us, and we're along strike. So Magnetic Resources have their Lady Julie gold deposit there, and you can see the intercept 22 metres at 4.1, 16 metres at 5.6. We also have our project in Southern Africa, so Namibia. This is an exciting project. It's sort of been on a bit of hold lately because of COVID and travel issues, but so it's located in the Kining Cobalt province. It's quite a large landholding, actually, 700 square kilometres. Access is very easy, road infrastructure is very good, 800 kilometres by road from Windhoek and 750 k's to the port. So I'll just try and point to this one here. So the interesting thing about this project is it's in the Neo-Proterozoic Kayoko belt, which is actually the western extension of the Central African belt, which runs down through the DRC, through Zambia, and then just swings across the northern section of Namibia. It's relatively poorly explored, so we're pretty excited about that. This shows you an outline of the tenements. You can see to the south, there's the Oklo Copper Cobalt project. I mean, they have defined a fairly large resource already, 225 million tonnes at 0.1 1.2% cobalt and 0.4% copper. This is hosted in the Dollarstone ore formation. In that figure, that's the white dotted line that also wraps around into our tenure. We've got about 30 strike kilometres of that to test. So that's another target that we'll be looking at. To date, aeromagnetics has been completed across the project, EM, some surface trenching, and soil sampling. So our best target to date is the Camwe prospect. You can see that one circled there. It's got a geochem anomaly, magnetic anomaly, and also this is the TM. We still need to get this modelled, and that's going to be our sort of next phase of work, getting the EM modelled and doing some more work out there. This is just to show you the distribution of mineralisation, and you can see that Camwe lights up. So this is copper and cobalt surface sampling. The samples were collected here on a one square kilometre grid, so it is quite coarse. However, it does highlight areas of anomalism. Oh, and there's a nice little rock up in the top right-hand corner, which is actually out on the desk there. So the grab samples out there are quite high grade as well. So we'll be doing a full commodity review on Kayoko, just basically refreshing this ground, getting some modelled EM conductors, and then we'll determine what's best for drill testing. So you can see this is just showing you manganese, zinc, and also a bit of a lithium anomaly at Owavenga. So we'll do some more work, infill all of those anomalies that we deem to be worthy, and then drill test the best ones. Onto our joint venture projects. We've got the Mount Venn gold and nickel joint venture. This is managed by Woomera. It's a relatively unexplored greenstone belt to the west of Gruyere. They've been actually drill testing fairly actively the Three Bears gold deposit, or Three Bears gold prospect, sorry, which is a 7-kilometre mineralised trend. They recently moved their focus onto Mount Cumming, which is located in the north of the tenement area. So this is an ultramafic complex with prospectivity for nickel, copper, PGEs. This is their current targets. So you can see this is the Mount Cumming complex with a number of ultramafic sills, and they've also got a number of EM targets, which is pretty exciting. They've drill tested a couple. They've intersected disseminated sulfides, so they know it's a fertile system. Now they just need to do some more drilling and try and target that basal contact. Drilling continues there at the moment, actually. They've got a rig on site, continues to drill. The Mackenzie Springs joint venture. So this is currently managed by Firefinch Resources. So this is a proven mineral district as well, located in the Kimberley. We're along strike of the Savannah nickel deposit, about 13 strike kilometres prospective basal ultramafic contact. There's gossamer samples at surface, and the last round of drilling done by Fin intersected disseminated sulfides. And they also identified an off-hole EM conductor, which needs to be followed up. Cazaly, in addition to their gold and copper projects and cobalt, also have a number of royalty streams. So in 2019, we sold the Parker Range iron ore deposit to MinRes. That was sold for $20 million cash. Almost half of that was given back to shareholders, and also retained a royalty there, 50 cents a tonne, after the first 10 million tonnes. They're currently in production, so we should see that stream commence in a couple of years' time. We also divested the Hamersley iron ore project that went out to Equinox with a very large resource, 343 million tonnes, 54% iron. So Equinox are really pushing this project into development. They're continuing to do their studies. Cazaly has retained a large interest there, 15.7%, performance rights, and also a royalty. So in summary, we've got a great cash position, cash and investments at the moment of $13 million. We've got a great technical team, so we're well placed to drive all of our projects. Also continually looking for other advanced projects to fit into our portfolio, and moving forward with those. So the plan for our next 6 months will be drilling Halls Creek, which we're very much looking forward to, surface sampling out at Yabby and the Ashburton to generate drill targets. And then the most prospective will be drill tested with a bit of luck early next year, as things are taking a bit more time than has previously been expected. But we're happy to say that we're going to be on the ground drilling Halls Creek before the end of the month. Thanks.
Thank you very much, Tara. As you walk off the stage today, come on, that microphone. That's okay. That way the ASX can hear nothing. But you said, she did mention that you had a gold bar in her house, didn't she? A real gold bar. How big is the real big gold bar?
Actually, only that big, it's 2 ounces.
I was thinking, geez, how good must your security, your house be?
It's nice. Nice.
Nothing to say. It's all right. Most of them are here. You're in the West Australia. You'll be okay. Team, our next prospect for you to consider is a company called Oklo Resources. Now, they're a gold exploration company whose land holding covers some very highly prospective greenstone belts over in Mali, West Africa. So the company's current focus is on West Mali, correct? Yeah. And in particular, its flagship Dandoko project, which is located east of the prolific Senegal-Mali shear zone, near numerous world-class gold operations. Would you please welcome to the stage the Managing Director and CEO, Simon Taylor, to tell us the Oklo story. Welcome, sir.
Great, thanks very much, and it's great to be here. And first time I've worn a suit for a while after COVID, which is fantastic. So good to see everyone out and about again. So we're in West Africa, we're in West Mali. What I'll talk to you today is about our resource that we have already in place and why we believe most of that resource has a potential high conversion to reserves, because of the way we've constrained it in pits, and it's real ounces. So we're not haven't put out a number that, in a year's time will be halved or whatever. It's real ounces in the ground, and I'll talk to you about the resource. And then I'll talk to you about how we're going to grow that resource and the numerous targets that we have on the project. Our disclaimer, and we'll get straight into the projects. So we're in, as we said, we're in West Mali. The black line you can see here is the Senegal-Mali shear zone. It pretty much divides Senegal and Mali, with Senegal on the west and Mali on the east. Our projects are in yellow. We've got about 500 square kilometres, and you can see some very, very big deposits around us. To the northwest, to the Barrick gold mines, 17 million ounces, the Ngoko Lulu complex, which is one of the largest underground complexes in the world. And just to the east, to the west of us, is the B2 Gold Fekola project, which is over 7 million ounces. Fekola is a unique ore body, and it was found by an Australian company called Papillon Resources, and sold to B2 Gold back in 2014 for, I think it was about $500 million US at the time. The significance of that deposit is that our chairman, Mark Connolly, was MD of Papillon at the time, and our exploration manager, Andrew Boyd, was instrumental in drilling out the Fekola deposit. So we've got some fantastic in-country guys working on our projects with very good knowledge of West Africa and Mali. So a fantastic team. What we'll talk about is Dandoko itself, and later on in the presentation I'll touch on some of the projects to the southwest of us. As I mentioned, great team and also great shareholders. BlackRock own over 10% of the company, as do Resolute and the Rougher Gold Fund. So our top 3 shareholders own about 30% of the company. We're capped at 45 million at the moment for a company with just under 700,000 ounces of resources in the ground. Our share price has drifted in the last sort of year since gold juniors have struggled, and we've had some selling in the stock. So it's a fantastic opportunity to be looking at Oklo at the present stage. We've got plenty of cash at the moment, over 4 million. We've got another drilling program starting up before the wet season, which we'll have done by July. And as I said, we've got a fantastic team, and rounding out our team is Madani Diallo, who's our director in country, a Malian national who was BHP's exploration manager for Africa for about 10 years, based out of London, very well educated. So when you're working in West Africa and places in this region, you need very good in-country expertise, not only on the locals, but as I said, also experience from our team from previous discoveries. Here's our main project, Dandoko. This colourful map is a is an auger image of gold in shallow holes that we drilled in 2016. And you can see that it's lit up a corridor, over about 15 kilometres across this northeast trend. And we started drilling in here at Seco. You can see there's a whole lot of other targets that we'll get to. And our resource, as I said, is very robust. 79% of it sits in the measured and indicated category. Good grade, just under 700,000 ounces at 1.8 grams, which is fantastic for open cut. And it's got all the, I'll show you an image shortly. It's pit constrained, the royalties, the taxes, dilution, mining loss, etc. in there. So we've got a potential here to convert most of this to reserve. And our goal is to get to that 1 million ounce ratio where we can then start looking at financing, etc. as we move the project forward. What we also like about the project, it's got real potential to high grade in the early stages. You can see at different cutoffs at a gram, and we've got 570,000 ounces there at over 2.6, and at 2 gram cutoff, a higher cutoff, which is the top line there, there's over 400,000 ounces there at 4 grams. So there's ability to, in the first 2-3 years of mining, to pull out 2.5 to 3 gram dirt, as we're seeing in our internal scheduling. So very good payback, and really sets us up for early cash flow and being able to pay back capital quickly. And it's very robust to the gold price as well. You can see on the right-hand side there, at $1,500, it only loses about 8% of the ounces. So it's going to make good money in good gold prices, bad gold prices, but it's high grade, and we've got a lot of flexibility to move forward. What does it look like? Predominantly 3 pits here, Seco 1, Seco 2 and Seco 3. We're very inventive with our names. The large one you can see on the right-hand side is Seco 1. 65% of the resource is oxide, so cheap mining, cheap processing. And I'll show you a couple of cross sections through each of these pits. You can see the pit outline around the area, but you can also see outside the pits numerous drill intersections that haven't fallen into the resource, either because there's some depth constraints at the northern end where we'll start looking for underground material, or there's a lack of drilling, particularly down the southern end of SK1. So looking at a couple of cross sections through SK1 and SK3, just to show you what they look like. Mineralisation from surface, good continuity. This is showing you the measured category of the resource. And as I said earlier, there's a real opportunity here to mine high-grade ounces early on in the project's life. Good network, non-refractory, simple processing route. We're getting up to 97% in the metallurgy, and 85 and 88% in the fresh. As I said, 65% of the project is oxide, and that'll be the early starter. When we step out from Seco itself, the trend, you can see an image here of the Seco areas up to the north, the 4.5 kilometre long Bembala trend here where we need to continue drilling to grow ounces, and also another area here, Dissay at the south end, and I'll show you some drilling results from there as we move forward. So how are we going to grow it? We're going to drill areas to the north and south. This is some of the work we've been doing since we put out the resource last year. This Dissay area here, some very good grades there, 21 metres at 5, 3 at 22, etc. It's a different style of mineralisation to the Seco pits. It's a cross-cutting, narrower zone that we can now chase because we've got the robust oxide to underpin the resource. And similarly, we've got the Bembala trend that runs all the way down for 4.5 kilometres to the south, and we've had some recent numbers down the south here of 18 metres at 2, 12 at 2, those sorts of grades. So you can see there's none of these numbers are in the current resource, and you can see the potential here to grow our numbers. Dissay is a very interesting area, the one I mentioned that is different to Seco itself. There was only about 12,000 ounces converted here into the resource when we put the resource together, where you can see these shallow pits up here, but all of this drilling here is has happened in the last year. Some fantastic numbers here. And those of you that may recall the West African Resources Company, were in a similar position to us before they found what was called the M1 shoot. They had a million ounces in an oxide resource. They then went into M1. They drilled a zone that was literally 100 metres long, and they've drilled it down to about 1 kilometre and found 1.4 million ounces at 10 grams. That's now gone in production, and they and Perseus are the lowest cost producers on the ASX, producing companies on the ASX last year, and they're both in Africa. So it's a good place to be. So we're going to continue to chase this with drilling. We're also going to continue to chase projects away from Dandoko. We've got Sari, Karoofing and Candiole down here, all truckable distance to Seco, where we will have our central plant. And I'll just show you a couple of slides from Sari and Karoofing as we move forward. Sari is, like Seco, a brand new discovery by the company. We believe you can see this blue image here, radiometric image. It's an intrusion sitting in a dilational zone. And on the edge of that dilational zone, there's again anomalies in our very shallow auger that we did early on the project. And our first drill line into Sari across here has hit 24 metres at 2 grams, and we haven't followed that up yet. So we'll be stepping north and south of Sari. And what we really like about this area, there's potentially a mirror image to what we're finding on the western side, on the eastern side here, where there's anomalism again in the shallow auger drilling. And the reason we haven't drilled this side yet is this is a separate tenement that's just been approved. So we've got drill pads out here ready to go. We're going to be drilling north and south of this discovery line, and we'll also come across and start looking at on the eastern contact as well. So you can already see this has the potential to be a system in its own right. But more importantly for us is putting ounces together here that are truckable to Seco as we build on that initial resource inventory. And lastly, our Karoofing project, again, which is down to the southeast. This is an auger image again, shallow auger. You can see has lit up a very strong gold trend here over about 6 kilometres, and we've put some early drilling in here, really to satisfy Mines Department expenditure early on, and we've got some terrific hits here, wide zones of mineralisation of good grade. But we haven't been able to come back here. As a junior, we can't do everything, so we've really been focusing on our Dandoko project and getting that to that resource stage, and then we'll come back and start looking at these other areas. We've got a structural geologist on site at the moment, going through all the core from the recent drilling. I'm heading back up to Mali on Saturday, which will be fantastic. And just to reiterate, during COVID, we haven't stopped working. We're very fortunate that we've had two expats geologists live in the UK and one in France. So we've been able to get them in and out of country continually through the COVID situation. We've got a fantastic Malian team operating on the project. We're very strong about our partnerships in country. This is a water well that we recently opened at the Seco village nearby. Very strong on our ESG principles. We're moving forward. We're growing the resource. We'll be pushing ahead with technical and scoping and social environmental studies and going for our mining license. And I've run out of time, and that's our story. And thanks very much for listening to the Oklo story.
You haven't quite run out of time. You still had 2 minutes up your sleeve. Little bit. Was that you at the well just then with the kids smiling? Enjoy your time there.
Yeah, it was great. We opened the well for them, must be 2 years ago. Previous to that, the water was collected from the local creek. And there's a wet season there, July, August. So there's lots of water around there, but come this time of year, it's pretty dry. So to be able to, the delight in the kids' faces when they saw fresh water coming out of a pump was fantastic.
I thought it was reflected by the joy in your face. It was a gorgeous photo. Thanks for coming up and talking with us today, and go and see the man at his booth and get more details on that project. Simon Taylor and Oklo. Thomson Resources, come join us on stage. Thomson Resources, here he comes all the way from the back. Right, it's a diversified minerals explorer with a primary focus on becoming a silver producer, and in a very short period, the company has acquired various projects in northern New South Wales and also in southern Queensland, and the target is to deliver 100 million ounces of silver equivalent for its New England Fold Belt hub and spoke strategy. This man is Executive Chairman David Williams, and he will be presenting the Thomson story for us today. Please make him very welcome.
Thank you very much. I well remember it in the Gold Coast in June of being introduced as the Tin Man. When I was at Noosa in November, I corrected that by I'm really the Silver Fox. And then recently in Brisbane, with the floods in Brisbane, I said, well, I actually feel more like the Water Boy. Now, I'm pleased with La Nina going away. I'm now starting to apply the zinc, but doesn't mean you call me the Zinc Man. Okay, sitting behind me there, you can see actually the Texas site. Now, I loved it in the middle of COVID of being able to say to people, look, I'm just a couple of hours into my trip from Texas. I'll ring you in a couple of hours when I get back. And they'd say, Texas? You've been to Texas in the middle of COVID? More of that later on. Okay, so what are we about? Thomson is about being a silver-focused developer and becoming a long-term economically sustainable producer of silver in Australia. We could see the opportunity with silver being very underrepresented as a focus of development, mineral development in Australia. Yet when you go and talk to people in the Northern Hemisphere, they could see the importance of silver as a technology metal, not just as a precious metal, but as a technology metal with the development of electric vehicles, solar panels, 5G, and so it goes on. But we could see in an area, and we're already in New South Wales, that there'd been a very active mining of silver in the late 1800s, 1900s, and yet nothing since then. It had sort of been a forgotten area that once World War I started, people disappeared. And so we could see the opportunity both in adding to investment opportunity for people in silver in Australia, but also in our own backyard up there in northern New South Wales, and not to forget Texas in the southern Queensland. So we set about bringing together the projects. We set about targeting projects that had operated as mines, had published resources, and had exploration upside to be able to get to that critical scale and that longevity of mine life. And the way to do that was collecting projects through a hub and spoke strategy. Now, we were very active about doing that over a 4-month period and bringing these projects together, and very active then in looking at how could we make these work together. So where is the New England Fold Belt hub and spoke strategy? So there you can see Texas, the real Texas is actually in southern Queensland. Down there at Inverell, these are all wonderful names. You've got the Conrad project, near Emmaville or Glen Innes, you've got Webbs, and then across at Drake Village or just out of Tenterfield, you've got the Mount Carrington project. Now, bringing these together as stage one brought together a series of projects that were focused on silver, but with other minerals, a series of projects that each in their own right would not operate, would not be commercially sustainable, but each which were within a reasonable trucking distance so that you could look at putting in a centralised processing facility in order to process with a single facility and therefore get the advantages of the economy of scale. But the secret to that was actually understanding what was the actual resource. The secret was understanding the metallurgy and the mineralisation, because that's fine. I can get up here and talk to you, hey, aren't I fantastic? I've got all these projects together, but they might not work together. They are different deposits with different compositions. So for this to work, we needed to be able to understand the metallurgy, understand the value that was sitting there, understand what the real ounces were, and understand what we could produce out of it, and then critically, what would be that central processing facility and what would be that processing pathway. So the concept of a centralised processing facility, bring in the concentrate, bring in the rock, run it through a process, and then take from that process, typically, as we're now seeing, that will be first of all a grind, and then extracting out the valuable minerals either in the form of a concentrate or in the form of going through other processes in order to extract the valuable minerals in a saleable form. But the key was to avoid what had happened with a number of these projects and to simply remain focused on the silver. Silver is the key. Silver is the focus. But silver generally does not come on its own. It comes with other minerals. It comes with gold, comes with zinc, comes with copper. Each of those are critical minerals as far as going forward in the new age of needing the technology minerals. So if you can get value for those, you significantly enhance the economics of the project. So, looked like we weren't doing much in the second half of 2021, but in actual fact, we were working away behind the scenes, pulling together all the tens of millions of dollars of previous exploration work done by previous operators, relogging the core, relogging the chips, pulling together the databases, validating them, checking the QA/QC, filling in the metallurgical gaps, looking at the mineralization, doing surface mapping, bringing in structural geologists to understand what really is going on here, and then ultimately producing our own mineral resource estimates. And I have to keep pinching myself because I keep thinking, well, gee, we've taken a long time in doing this. But the practical reality is we really didn't start the work on the mineral resource estimates all to JORC 2012 until the start of the first half of last year. And when we released the Webb's mineral resource estimate later on in this month, we will actually have produced 5 brand new mineral resource estimates in less than 12 months. And that in practical reality is a fair feat. And that's what we've been focusing on, although often not recognised by the market. So you can see we're a long way there with what we've published on Conrad and Texas. We're up to over 40 million ounces with an average grade of around 86 grams per tonne of silver equivalent. When Webb's comes along later on this month, we'll be even further advanced along our target of 100 million ounces. And then when we can start talking about the Mount Carrington project, which we're earning in with White Rock, and we can talk about it in its broader sense of the polymetallic mineral resource estimate, you'll very quickly see that we're at our and getting to our target of at least 100 million silver equivalent ounces available to a centralised processing facility. So there it is, that's what we've done. We've acquired the projects, we've pulled together the historical information, we've validated all of what I was telling you before. We've done 4 out of the 5 mineral resource estimates, not including Mount Carrington. And again, we'll target coming out with that polymetallic mineral resource for Mount Carrington. We're developing the exploration programs. We're finishing drilling at the moment down on the Lachlan Fold Belt. That rig will move up to Texas and start drilling on extensional and expansional targets at Silver Spur. That drilling will then lead into updated mineral resource estimates. We've already kicked off that centralised processing pathway study, and we should have the results from that in June. And that will give you what is going to be a high-level design of the centralised processing facility, the high-level capital cost, and the techno-economic evaluation of the project. So essentially, we will have done the scoping study and then can move forward into the PFS. So that's Texas, a lot of infrastructure. It's a heap leach operation left on a turnkey basis. Last operated in 2019, supportive community, good infrastructure, pretty much equidistant time-wise from each of the deposits. It's a fairly obvious place for the centralised processing facility, not something that we've firmly decided on yet, but we will in the next few months. With each of these mineral resource estimates, we're doing our own geological model. And as we're seeing on each of these, we can see where the immediate exploration upside is from both an expansional and extensional. And there you can see Conrad, you can see the superimposed pits, as well as open to depth, open along strike. Conrad's a pretty easy one. We know what we're going to find. We just keep going southeast and we'll keep getting more of the same. Just follow those old workings up the creek and there you'll get it. So good silver with a lot of lead and tin in it. Texas, the 3 deposits, Silver Spur, which kicked it all off in this region, Twin Hills, which was what was mined and forms the heap leach pads at Texas, and then Mount Gunyum just further to the north. We see the Stokes Fault going from Silver Spur through to Twin Hills and on, unfortunately, through those heap leach ponds, but isn't that funny how often that happens? We're already just completing an IP survey across Twin Hills and down to Silver Spur, and we can see the targets coming up. So we expect there are going to be a lot more targets for drilling that will again be very similar for what we were seeing through the geological models, that each of these 3 deposits in the Texas project have higher grade cores. But by being larger resource with the larger projects, it means that instead of trying to get a project up on the one deposit, we're actually able to be more focused in this area and be more focused on those higher grade cores. So we're looking at a higher grade resource. And we can see already from historic geophysics and also from this IP survey, these higher grade core deposits continue on. There are a number of targets within the area, all within sight of each other. So we can see a lot of upside, resource upside from both Silver Spur as well as the Twin Hills deposit. And Silver Spur will be where we'll start our focus on later on this month with a drilling program, which will then just continue on with these projects. Webbs, we've just completed the modelling of that, and again we can see a number of areas of extension. This one's been a little bit more complex from the geological model, and you'll see that in the appendices to the presentation, but lots of opportunity as far as to depth and on strike. Lachlan Fold Belt, referred to it as our set of steak knives. You know, this is gold and tin. Baigu, which we've just completed drilling on, again, a lot of rain, a lot of interruptions, but really has high grade tin as we go forward. Our objective there is to produce a maiden mineral resource. Couldn't do this without the team, and particularly we're building our own team, but it's particularly the consultants around us. It's been a big exercise, and particularly without Global Ore's support, we would have been floundering. There's the corporate side of it. I will say that our share price has been beaten up a bit, but I think once we get these last numbers out and I can talk about them, then people will see how real this is, and it's not just well, here's a bit of a story and here's a few projects. That's where everything is on the eastern seaboard of Australia. We're purely focused in New South Wales and Queensland. What's silver doing? Well, I could talk for some time on it, but I think it's an interesting development with silver as far as its linkage with gold and its use as a technology metal. So you can see how that gold-silver ratio has got out of kilter, which is that influence of the technology metal. But I still think we will see, getting towards the end of the year, silver heading back towards more that $30 US. Final slide. I coined this phrase of we treat this as mining as a business. It's a bit of a spoof on SaaS, I appreciate, but that's what we're about. We're not about the quick wins and a quick sale and a spike of the share price. We're about putting this into production. We're about seeing this as being a long-term, commercially sustainable, silver-focused producer in Australia. ESG, run out of time. There we go. Thanks very much.
Lachlan man from Texas, just Lachlan. Go and see him out at Thomson to have a chat at about +5 when he's having a drink. I'm sure you might become well lubricated enough to share something. No, you won't. That would be naughty. All right, we're moving on. ioneer Limited is seeking to develop the world's next large-scale lithium boron project. Where? in Nevada, USA. Their Rhyolite Ridge project is the most advanced lithium-boron development project in the US, and you just happen to have strategically located that next to the world's second largest car market, have you not?
That's right. We have good planning there.
This gentleman here who's joining us is, well, he's a pretty happy man for the last few days. Been pretty hard to get hold of as well, from what I understand. The media's been on his tail. This is ioneer's MD, Bernard Rowe. Would you please make him welcome, everyone?
Thank you very much. And after, I think it's now 19 years since I first went to Nevada, I've learned to say Nevada. So when you hear me say Nevada, 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 that's just so you know, that's how they pronounce it in state. And so it's something that I've made sure and insist on now whenever I'm over there and here too, that I must pronounce it Nevada. So our mission at ioneer is to produce the materials that are necessary for a sustainable and thriving planet. And we're delivering on that mission by bringing into production a truly world-class deposit, Rhyolite Ridge, located about halfway between Reno, Nevada and Las Vegas. Truly amazing deposit, one of only 2 lithium and boron deposits of size anywhere in the world. The second one being Rio Tinto's project in Serbia. They're closely related, the two of them, but they're different as well. There's nothing else like them anywhere else in the world. Please read the disclaimer before making any investment decisions. So on this talk, I'm going to focus on a few areas. The lithium and boron market, very briefly, a corporate overview of ioneer, a few words about the project itself, but really I want to talk about the next steps, what's coming up over the next couple of months and through to the end of the year. And I think I'm available for questions later, so we won't have time for that when I'm up on stage, but please come and visit us afterwards if you do have questions. So the lithium and boron market, I think everyone's got a view, and it's, I think, almost united in the positive outlook for lithium. We don't hear many people with a negative view. But just to put some numbers in context, the world produces plus or minus 500,000 tonnes of lithium chemicals a year. A few years ago when I started working on this project, it was actually only around about 300,000 tonnes. So it's grown quite quickly, but it's still a small tonnage. Most think that with the take-up of EVs, and that's what the demand is all about, we're going to be going from about 500,000 tonnes to about 3 million tonnes of lithium chemicals global demand by the end of this decade. And on the graph on the right shows that there's a problem with that, and the supply equation doesn't, they don't coincide, they don't meet. And so there's an increasing deficit, particularly from about 2025 onwards. And what that's going to mean is that by the end of this decade, there's going to be a shortfall of lithium chemical of around about 500,000. Some people put it as much as 1 million tonnes a year. So that's the total world production as of today as a shortfall in less than 8 years. Quite amazing, and that's what's going to drive a high lithium price for a long time into the future. In the US context, we will become the first lithium production in over 50 years, a new lithium production in the US. The US is insignificant in what it produces today. It's about somewhere around 5,000 or 6,000 tonnes of lithium. It's going to need hundreds of thousands of tonnes of material by the end of this decade. So in terms of domestic supply in the US, there is none today, but there has to be, and everyone, including the US government, bipartisan, agrees on that. It's the second largest car market in the world. It needs domestic lithium. Borate market. So this is a lithium and boron deposit. The boron is not a byproduct, it's a co-product. It's more than $100 million a year of revenue from the boron. So it really is a major contributor to the economics. Boron is used, people probably, and maybe until recently, have heard very little about the boron market. It's a duopoly, Rio Tinto, the Turkish government. But it's the thing about boron is it's incredibly stable. Some people will say boring boron, it's anything but boring. However, it does have a very stable supply demand. That's what's kept prices stable for more than 100 years. It's used in a myriad of applications, and some of them are listed there. Borosilicate glass is the big one though. US is the second largest consumer in the world behind China. What people don't know, though, about boron is actually it's a fundamental material for electrification as well, not only because of borosilicate glass and solar panels, but also because it's used in a myriad of applications in electric vehicles, from the TFT screens, the carpets, the electric motors, the neodymium ion boron magnets, the boron carbide that makes up the chassis as boron steel, very strong and very lightweight. Companies like Ford and Volvo, out of the blue, are starting to talk about this material as an essential ingredient for electrification, which is a good thing for us. Corporate overview, I think the key things there are that we're a company with a market capitalisation around about 1.4 billion. We have $144 million in Aussie dollars in cash, so we're well funded. We're funded through to FID. And our share register is also impressive. We have Centaurus and Sibanye as our two largest shareholders, but we also have 25% rather, institutional holders, and I think it's about 30% plus or minus that are US shareholders, which is important when I come to talk about some of the things that are coming up in the future. So when you're building a project and a mine like Rhyolite Ridge, like ioneer, it doesn't really start out on the ground, of course. It starts with building the team. And I must admit, I must be one of the most fortunate MDs of any ASX company, particularly resource company, with the board and the management team that I've got around me. But extremely fortunate. I'm not going to go through all the names. You can read them for yourselves. But if I look at it, at what we're trying to do, and ask the question, do we have the team to be able to do it? Then we've got a team that has engineered, designed, built and operated large lithium, boron and chemical projects around the world. We've also got a team of sales and marketing people that have sold lithium and boron around the world that have mainly come out of Rio Tinto. We've got a team that's financed large projects before, and that puts us in a fantastic position to deliver on this project. And we're surrounded by world-class partners. That's been a key when we've been selecting the types of partners that are listed there, and cornered by, of course, our strategic partner in Sibanye-Stillwater, who will become our 50% joint venture partner when we make a final investment decision. So the Rhyolite Ridge project itself, located about halfway between Reno and Las Vegas. It's very close to sealed roads. It's on public lands. There's no competing land use. It's an area where I myself personally have worked mainly in gold exploration over many years, so I know the area really well. The economics that are shown there on that slide come from our 2020 definitive feasibility study, so it's 2 years ago since we finished that work. But what that shows is we can produce about 22,000 tonnes of lithium a year, lithium carbonate and lithium hydroxide if we choose to produce that, 174,000 tonnes of boric acid. So it's about 1 tonne of lithium, around between 7 and 9 tonnes of boric acid. So by volume, there's a lot of boric acid. By revenue, it's about around 30%. That boric acid at more than $100 million a year means that about 70% of our costs are covered by boric acid. So if you like to think of it as a byproduct or a credit, then that will make us the lowest cost lithium producer in the world at around about $2,500 a tonne of lithium carbonate after that boric acid credit is applied. It's an $800 million project, after-tax NPV of 1.2 billion, 5-year payback. So we talk about this as being the most advanced lithium project in the United States, which it is, and these are the key things that justify that statement. We're on track to be construction ready by the end of this year. The engineering will be done. That will allow us to commence construction. We've done a full simulation pilot plant. We've probably spent around about 110 or a little bit more $1 million on this project over the last 5 or 6 years. Our environmental baseline studies have all been completed and accepted by the federal government. We have binding offtakes for boron in about a third of our lithium production. And we have this Sibanye-Stillwater joint venture that's been announced that I mentioned, $490 million investment upon FID. Strong commitment to sustainability. And this relates directly to the deposit that we're dealing with that allows us to do this. So we are not connected to the grid. All of our power comes from our sulfuric acid plant. So we have no electricity, no gas pipeline. The power all comes from there. The heating comes from there. And in fact, we may end up having some surplus energy that we can later sell into the grid. There is no grid lines near us at the moment, but we think they'll be built in the future. The process, though, also allows us to be a very low water user. So we're doing a leach like you would an oxide copper. We could have done it in a heap leach, but there are reasons why we do it in a vat, which means we control and contain all the water. Something like between 50 and 60% of all of our water gets recycled. So a low water user, no tailings because we can dry stack the material. So we don't have any tailings ponds. We don't have any evaporation ponds. So we have a very small footprint. We're using cutting edge with our partner Caterpillar equipment and energy efficient equipment. And we've got this really strong commitment to sustainability, which applies across all those things that I've just mentioned. So next steps. Key work streams over the next few months are on this slide. So we've done about a third of our lithium under offtake. That's with EcoPro Innovation, one of the largest cathode makers in the world, a Korean-based group. But we've got 2 additional lithium offtake agreements that we expect to close this quarter. We've already announced that they will be into the US supply chain. We want this Nevada lithium to stay in the United States. And so that's been a key driver of who we're partnering with on offtake. And you'll hear more about that over the next, between now and the end of June. We're planning a listing on the NASDAQ. That's very advanced. We're also expecting that will happen over the next 2 months. We've done a lot of the preparatory work and we're just finishing off a few filings. That comes back to 2 things. Why are we doing it? Because we have already a shareholder base that is a significant shareholder base in the United States, but it's more than that. It's about, this is a fundamental project that's going to supply lithium into the United States electric vehicle industry as the whole energy space transforms. And it needs to be listed in the United States. That's the view of our board and my view also. On project funding, we mentioned $490 million from Sibanye. That leaves us with another, $400 to $500 million. We're looking at putting in place $1 billion of funding in total. And in our case, what we've done is applied to the US Department of Energy under their ATVM program for debt funding. We were the first, as far as I'm aware, the first lithium company to be invited formally into that process. That happened late last year after most of 2021 spent doing due diligence with them. But they've invited us into the sort of more formal part of that due diligence process. We're right in the middle of that now. So, we would be expecting an outcome of that later this year. We're also in conjunction though working with Sibanye and Goldman Sachs on alternatives. If we're not successful, we think we have an excellent chance of being successful. But if we're not, we have alternative plans for the financing. And obviously having a partner with a strong balance sheet like Sibanye makes a world of difference. On the detailed engineering, that work has been continuing. When we finished the definitive feasibility study back in March, April of 2020, but we didn't stop there. We could have parked it and just sat and waited, but we didn't. Our board made a decision. We had the capital in place that we would continue that engineering work with Fluor, with SNC-Lavalin, with Fluor and SNC-Lavalin to ensure that by the end of this calendar year, we are ready to take the machinery out on the site and start ground preparations. Obviously, that's subject to permitting, and we've been working on the permitting as well. There are many smaller minor permits required with an operation like this, but there are 3 key ones. We already have 2 of those granted, and the third one, which is known as a plan of operation, which is issued by the Bureau of Land Management, part of the Department of the Interior. We are working closely with them, and we've made some revisions to our original plan. We're about to resubmit that into the BLM, and we're expecting that would then move into the final stage of permitting process. So that puts us in a strong position to be making that FID in the first half of next year, and being in a position with the financing and the engineering in place to immediately commence construction. Thank you very much.
Bernard, thank you very much. It was a very interesting discussion. And Nevada? Okay, but some people come to the WA and they say the Kimberleys. No, there's no the Kimberleys, it's the Kimberley or Albany. There's all sorts of little quirks out there with language around the place. Right. I know we're all looking for something here. We're all got our little niches that we like to invest in. Are you looking for the following? Low risk, low cost, near-term copper production? If so, look no further than the Can-Man-2 underground project, which is in South Australia, which Hillgrove Resources is fast-tracking to become Australia's next copper gold mine. This gentleman joining us on the stage is the Managing Director. His name is Lachlan Wallace. Please make him very welcome.
Thanks very much. Today I'm going to be providing an update on the Can-Man-2 underground, which is really on the cusp of becoming Australia's next copper mine. It's really good to be back here in person. Last time I spoke, since then we have been continuing to drill, continuing to expand the resource estimate that we have. We've also developed an initial mine plan which throws out about $200 million in free cash flow over the initial 3 years. The project is fully permitted. It has all of the necessary infrastructure in place, like processing plant, tails dam, etc. And we're now in the process of just finalising the pre-production capital funding that's required before we commence operations in the near future. As you can see in the background photo here, the early works for the underground have already commenced, and we're already encountering some really nice high-grade mineralisation. We'll jump in and take a look. So just first, a really brief corporate snapshot. We have a market cap in the order of about $90 million. We had $11 million in the tin at the start of the year, so an EV of around $80 million. And just want you to keep that into context as I sort of outline the value proposition that we have here today. So we are fully funded now to complete the remaining technical studies and to reach an FID point over the next couple of months, after which we would be putting it into production, relatively short pre-production period, about 7 months, until we're producing ore and then turning the mill back on towards the end of this year or early 2023. The only other thing I really want to draw your attention to on this slide in particular is the carried forward tax losses, so a bit over $220 million. So obviously, as we start to get into copper production and profit associated with that, there's some high level value to the project gets delivered back. And in addition to that, we have over $17 million worth of franking credits, which enable us to push out around $50 million worth of fully franked dividends at the appropriate time. So for those that aren't familiar with the project, Can-Man-2 is located about 55 kilometres out of Adelaide between 2 large regional cities of Mount Barker and Murray Bridge. It's a really unique value proposition. It's near term, low cost, has a very quick time frame into production, and it has a high level of resource upside. So as it's talked about, it's fully permitted. We have great relationship with the local townships of Callington and Can-Man-2. We have a 3.5 million tonne per annum process plant that we're maintaining in the care and maintenance regime at this point in time. We have a tailings dam that's fully permitted and operational, has around 7.5 million tonnes worth of additional capacity. In addition to that, being based in the lovely Adelaide Hills, it's an excellent place for a mining gig. So we don't expect to have any dramas in attracting and retaining a high quality workforce. It is the same geology, geotech and metallurgy as what we did in the open pit. So Hillgrove actually mined here from 2011 through to 2020. We produced around 137,000 tonnes of copper and about 55,000 of ounces over that decade from a series of open pits. So what we're looking at here is really just a restart of the previous operations with a different mining methodology. With regards to exploration upside, the stage 1 plan that I'm going to be talking about today, it talks to about 2 of the 9 known deposits that have been either mined or drilled as part of that open pit operation. So there's a whole heap of upside with regards to exploring the remaining site. And in addition to that, we have 3 advanced exploration opportunities within 10 kilometres of the processing plant. And with the plant running at about a 40% capacity, there's a huge amount of upside in that we are able to bring any of these additional loads into the mine plan without there being any material capital requirement or any permitting requirements for the process plant. So we have established a stage 1 plan. Basically, at a very high level, it pushed out about $200 million in free cash flow over a 3-year period. It has an NPV in the order of about $166 million for an IRR at about 389%. So, yeah, hugely valuable project, really quick payback. We're only seeking about $26 million in pre-production capital to put this into operation, and we're currently advancing discussions with a debt funding group in order to get that started in the near term. The following video here is just a time elapse of basically where we're up to, just to give you a context of the pit and some of the early works that we have started. We have pushed in a main decline using a Komatsu MC51. It's a new bit of technology. We were able to get $2 million out of the state government to fund a trial here. And this has enabled us to basically fast track some of the underground works ahead of an FID position. So the machine has come in here, it's cut a lovely profile. We would have liked to have got a bit further than what we did, but essentially this machine has been able to create 2 portals, so one for the ventilation drive, one for the primary decline. And what this has enabled us to do is to push the decline in far enough that we can establish an underground drilling platform, so some stope definition drilling. It's given us a really good look at the geotechnical conditions. And in addition to that, it's enabled us to set up some of that initial services in front of the portal, all before a development all before we have to make a final investment decision. The machine then was replaced with traditional drill and blast methodology, just so we could push the decline a little bit further, just to establish the stope definition drilling platform, which we are currently putting in place now, and with stope definition drilling starting over the next week or so. And then when the MC51 went up to the ventilation drive, we hit the mineralisation within 13 metres, so really short distance to be able to get this in place. And we've started trucking a bit of that ore to the ROM in preparation for the mill restart. From a timeline point of view, all the grey bars here are complete, and the orange is what's required to get it to first copper. So essentially, we've got a couple of big ticket items that remain. We essentially need to resolve the funding package. So we're now signed term sheets and we're in the definitive documentation stage. I expect that'll be completed over the next couple of months. In addition to that, we are just working through a mining contractor selection process. Also, I expect to be finished in a similar time period. After that, we're taking it to the board for a final investment decision. And then, like I said, about 7 months of pre-production works until we're into our first stopes. And then shortly thereafter, producing copper. So really short time frame to first copper. So that's the stage 1 plan. So it's $196 million, 3-year plan, about $26 million of pre-production capital. Now, the plan's relatively small and deliberately so, and I'll just take a little moment to explain that. We're afforded with a huge luxury, which is the processing plant. But in order, I guess, to make sure that the restart is very low cost and quick, we made a decision early on to make sure that we retain all of the energy contracts, the water contracts. So we're pumping water through the entire mill system on a daily basis. We're turning the crusher system on every week, running the conveyor system every week, inching the mill. And I guess in doing so, there's a cost incurred with that. So we set out with a stage 1 strategy, which was basically to spend as little money as we could, take as short a period as we could to get a debt fundable mining plan together. And I guess when we took this plan out to financiers towards the end of last year, we got a very strong response. So we'd say that we've achieved that, and we look forward to completing that funding package. But it's no way near the entire value opportunity that we're sitting on at the moment. So we have depth extension opportunities under the 2 main loads that we have been putting into this stage 1 plan, as well as a further 7 areas within the permitted mine lease that we would seek to explore to add both mine life and annual throughput. So just to put this into context a little bit, this is a long section. The grey areas here are the open pits. All the coloured dots there are positive drill hole results. And the black boxes are basically representing the extent of the stage 1 plan, which is limited to about 250 metres in depth below the largest pit. So in addition to that, what we have is the Cazaly lode. So Cazaly was an area we put out some drill hole intercepts recently, 170 meters, about 1.1% copper. There's another 166 meters at 0.9%. So these were generally in the order of 10 to 30 meters in width, 1 to 3% copper equivalent. And that's what we'll be targeting in the stage 1 plan. But again, it only went down, or the mine plan only goes down to about 250 meters because of the scarcity of drilling below that. But we have put plenty of holes in below the 250 meter mark. In fact, we've drilled down now to 500 meters, and we're demonstrating that mineralization continues to that depth and is still open at depth. The lowest hole we've got in this area is actually 3 meters at 1.1% copper and a whopping 5 grams per ton of gold. So an excellent target that we'll be following up on. I would fully expect that as we are able to do more drilling at depth in Cazaly, that will translate then into depth extension beyond the initial mine plan. Nugent's a similar story. So Nugent was an open pit, was mined 2015, about 100 meters in depth, 300 meter strike length. We've been drilling this area now over the past months. We put out some drill releases this morning. And what it basically shows on the right-hand image here is the blue blocks there representing the extent of the resource that's gone into the stage 1 plan. All the yellow dots there represent the new drilling. So you can see here, there's a lot of positive drilling results that sit both below and south along strike of the Nugent ore lode. So as we get these drilling results into a resource model, they'll be incorporated into the mine plan and we'll see an extension to the existing stage 1 plan. Still on Nugent, this is just a cross-section of the same thing. Again, the blue blocks and red blocks effectively representing the resource model of stage 1 plans built around. And you can see all those nice high-grade hits that are sitting below the pit, below the resource model, which will allow that to expand once those drill hole intercepts are incorporated into the model. In addition to the depth and strike extensions that we have in Nugent and Cazaly, we have another couple of areas we call South Hub and North Hub. So South Hub is a collection of 3 different work areas. It's Critchley, Pringa and Emily Star. Emily Star was again a mined area in about 2013 to 14. It was about 100 meters in depth and remained open at depth below the open pit. Critchley Pringa, you can see some of the excellent drill results we had there. So 17 meters, 3.6% copper, half a gram gold credit. Really nice intercepts to be able to follow up and bring those into an initial underground resource that then we can incorporate into a future mine plan. On the other side of the pit, we have what we call North Hub. North Hub, again, a collection of a couple of targets, North Cazaly and Coopers. North Cazaly was an area we did mine a portion of as part of the open pit, very steeply dipping. It's around 9 to 12 meters in width, nice grades in the order of about 1.8 to 2.1% copper with a half gram gold credit. The issue with it from an open pit point of view is because it's very steeply dipping in nature, as you go down a few benches, the strip ratio gets too high to warrant it chasing it from an open pit. So it wasn't the main target, but from an underground, it's perfect. Sits right adjacent to the ramp, so we can drive effectively straight into the ore lode. So we have drilled that around 200 meters of strike length there down to a depth of about 100 meters. And we've just put one hole that's at about 350 meters in depth just to demonstrate the mineralization is still continuing. So that'll be another area that we focus on with, again, the intent to bring that into a future mine plan. So just looking at the process facility, I've talked about how the process facility is a huge asset. What it really does is enable us to reduce the capital costs and reduce the time frame to get into initial production. But one of the things that, well, there's another two, I guess, things I want to touch on with the process facility. Effectively, all these loads I've been talking about, they are additional loads that can be brought in without additional capital expenditure in the process plant. We only utilise about 40% of the milling capacity in the stage 1 plan. So bringing these loads in is a relatively simple process to do, and they have the same metallurgical response as what we are experiencing in the rest of the site. In addition to that, because our loads are predominantly a high-grade core with a lower-grade halo, I guess we have the ability to be able to flex in response to changing commodity prices. So the higher the commodity price, the wider the stopes and the more material that we can push through the mill and increase that annual throughput. I guess what we have is the luxury of having an oversized plant with plenty of latent capacity so that we can do that again without any capital expenditure. I mean, you juxtapose that to other producers that may be looking at expanding their production. They've got huge capital costs, time, permitting requirements that they need to get through to be able to expand production. So just in summary, what we have here is a permitted, low cost, low risk, near-term copper production opportunity. We will get into production in 2022. With the strong financials, $300 million with a relatively small capital requirement in the order of about $26 million, we would anticipate that this will be an excellent project to start and provide sufficient cash flows to then reinvest and grow the mine life beyond that. And I guess back to that first point around EV, given that we are positioned right in front of copper production and we have this bullish outlook on copper prices, we think that an EV of $80 million is an exceptionally good value proposition. Thanks very much for your time.
Lachlan, well done. I reckon that was one of the fastest presentations at the end, but you squeezed it all in there. You got time to speak to us afterwards. Drinks are waiting. Oh, no, mate, I've got two more very important people up here. Thank you very much. And you can just sit at the back there. We're not letting you go either. Right, next one. This is, in fact, our second last presentation for the day. We're saving some of the best to last to keep you interested. Look at him. He's got a smile on his face. Firefinch is our next presenter to join us on stage. They are a Mali-focused gold miner and lithium developer, advancing both the Marilla gold mine, which was once the world's highest grade open pit gold mine, and the Goulamina lithium project, which is the next large-scale global lithium hard rock project to enter production. Firefinch MD is this fellow here. His name is Mike Anderson. He's going to tell us about, one, the demerger of Goulamina into Leo Lithium, and two, the return of Marilla to Marilla the Gorilla. Would you please make him welcome?
Yes, thank you, everybody. And look, it is great opportunity to stand here today, having launched that demerger on Friday. So probably one of the last times that I get the chance to talk about both of these fantastic projects under the Firefinch banner. So we are talking about both Marilla and Goulamina. But I'd like to reflect on the fact that a year ago was the first time I was back at the conference podium, having taken on this role. And I think we are pretty satisfied with the year that we've had, having added substantial value to the organization. We are now in excess of $1 billion market cap. I think our share price closed at $1.09 today. That's comparing with 35 cents a year ago. So anybody that went away from here last year having invested in Firefinch, hopefully there's some happy holders out there. But we genuinely believe there's a lot of upside left here. It's been a year in which we concluded the Goulamina transaction, the joint venture with Ganfeng that shapes to launch Leo into that standalone pure lithium play space. But we've also achieved a lot of operational advancement at Marilla, and now stand on the brink of accessing first Marilla ore again, bringing that operation back to initially 100,000 ounces per annum, but onwards and upwards to 200,000. We too have focused on our register and have been successful in attracting a substantial increase in institutional holders there, over 37% now, and that's a key as we go into this the demerger. Who they're supporting us very strongly. We also were lucky enough to be admitted to the VanEck Junior Gold Exchange, and those are all, I suppose, recognition of the value that we're adding and the size of this organization as it grows and looks to demonstrate the full potential of both assets. So the Gorilla is indeed Marilla. First came to production over 20 years ago under the Randgold and Anglo American joint venture. They mined over 7 million ounces. And today we stand with a resource base of close to 2.5 million. But I guess probably the biggest question for us right now is how big could this system still be? And we've had some very good results in our initial drilling. In fact, the first deep hole that we drilled in the far right-hand corner there yielded 10.5 meters at 34 grams per ton. That was a great start. While it's not as head turning, that 58 meters at 1.75 up on the western side of the deposit is material in that is inside the pit but outside of the resource and above our resource grade of 1.5. So huge contribution to the inventory and a reduction in strip ratio to find something like that. And then most recently, 5 meters at 30 grams on the western side in an area where we weren't supposed to find anything. And so we genuinely believe this deposit remains open to the west, the north, and the east, and at depth. And our goal here is to continue to drill. We now have 7 rigs in operation at Marilla to substantially bolster that resource and reserve base and to create a decade-long plus a decade-long future of plus 200,000 ounce production at Marilla. Right now, we, as I say, are on the brink of accessing first Marilla ore. Over the last 12 months, we inherited a tailings retreatment operation that has delivered around about a 50,000 ounce per annum run rate. We started mining at the satellites again. That was the first mining that had been done in this region for over 12 years. But it's Marilla that's the heart of this. That's the prize. And as we get in there, we can keep this 4.5 million ton per annum mill fed with ever increasing contribution from Marilla. So we ramp up. We issued some guidance in the last quarter for Q2, Q3, Q4. And we ramp up from what has been that 50,000 ounce per annum run rate to around 60, 80,000 ounces per annum this quarter, and 30 to 35,000 ounces per quarter, which is 120 to 140,000 ounces per annum annualized. So that'll add up to 100,000 ounces this calendar year, but then we're quickly into 150 to 200,000 type run rates for 23 and 24. We are intensifying that drilling, looking very much to maximize the resource to reserve conversion and demonstrating that longer mine life. We also believe that there's some significant underground potential there, and that's hard to argue when you've got 10 meters at 34. That's really high grade material. So look out for some news flow on all of that as we go forward. Some pictorial evidence here. So in the last 12 months, as I say, we've gone back mining at the satellites. We're now mining at Marilla. You'll see full-blown mining operations in place at Viper, our main satellite ore source at the minute. You'll see the pre-strip underway in the far top right there at the main Marilla super pit. The plant has been fully refurbished, fully operational again, as I say, at that annualized run rate of 4.5 million tons per annum. We're upgrading the SAG mill right now to give us even more flexibility. And interestingly, I said we inherited a tailings retreatment operation, so we actually have a virtually empty tailings storage facility at the minute. We've refurbished that, and it's now ready to get back into operation to support the plant. So the Firefinch value proposition from here, and then say, bearing in mind, we'll talk about the demerger in a moment, is that Marilla creates the foundation for a growing gold business, very material to us. You know, it wasn't a core asset for Barrick or Anglo American, but it's a key asset for us to put a foundation in place to grow this business. We are funded through to positive cash flow from Marilla. You know, we raised quite a lot of money last year to drive this business. We have that was an important plank, and there's huge organic growth potential at Marilla. And that resource reserve upside and the high-grade underground potential, we look to flesh out. We will then lift our heads to look at the M&A opportunities, and there's plenty of good precedent here over the years, the likes of Perseus and more recently West African, growing their asset base to become multi-asset companies, bolster that production base as a group-wide production of 500,000 ounces plus. Very importantly, and we'll talk about it in a minute, we will be retaining a 20% ownership of the lithium business. And we think that will be a key differentiator for us as we look to those M&A ambitions and the aspirations to grow. To talk about Leo the Lion, the Goulamina project. This is, I think, possibly flown under the radar for quite a few people, because when you understand the metrics of this project and all the ticks that it has in all of the boxes, it's one of the largest undeveloped spodumene hard rock projects in the globe. We have over 100 million tons of resource and over 50 million tons of reserve at 1.5% Li2O. That grade is again top quartile. Low impurities, and very importantly, we have our mining permit in place. We now have a world-class joint venture partner in Ganfeng Lithium, the world's largest lithium chemical producer. They're capped at $20 billion and who are a major player in the lithium space. All of these characteristics, the size of the deposit, the quality of the ore body, the low impurities of the concentrate that we produce, will no doubt have attracted them to invest with us. They're providing the funding to see Goulamina into production. That funding has now been unlocked with the formation of the JV, and that has also been the catalyst to launch into this demerger process. Of course, everybody who's spoken before today has talked about the EV thematic and the very bullish outlook for lithium price as well. we've modeled quite conservatively here at Goulamina. And quite frankly, spot prices today could see this project paid back in a couple of shipments. But even without that, there's a very healthy payback and a very substantial value proposition. Ganfeng, as I say, are an absolutely world-class partner. Their network of customers includes Tesla, BMW, VW, etc. They want this product. They're building a downstream facility to take this product, the entire stage 1, which will be about 500,000 tons per annum of spodumene. That would place us as number 2 in the world today. And then we have plans to grow after 18 months of production to stage 2, which would take us up to over 800,000 tons. Again, top a handful of producers in the world, recognizing that others have their expansion plans too. And they are hugely committed. They've been so supportive since signing the JV with us. They've been with us every step of the way, ready to write those checks and want to accelerate this project and be in production, which it will be in early 2024. The resource stands very strong comparison against its peers. And interestingly, a lot of those peers are pure lithium plays. And when you look at the size of some of these companies in terms of market capitalization, Pilbara in production, demonstrated a track record of production, capped at, I think it's 7 or 8 billion. Some of the want-to-be developers are capped at around 2 to 3 billion. So bear in mind that together, these assets in Firefinch are capped at $1 billion today. We see huge upside for the lithium business and indeed for the gold. And post the demerger, we hope to see some of that value gap closed. And there are good precedents for that. I think that probably the most poignant is Alkane and Australian Strategic Minerals. If we get that sort of outcome, we will have done well. But for us, providing that independence is a key part of the rationale. I do want to touch on the fact that we have been, as Firefinch and our predecessors, Mali Lithium, and prior to that, Brim Gold, we've been in Mali for over 10 years. And our relationship with the government is very strong at the minute. And why wouldn't it be? We've saved Morila from closure. We're reviving that mine. When we took it over, there was 200 jobs. There's now 2,000 jobs at Morila. Down the road, just 200 k's in the same region of Buguni, we are creating not just Mali's first lithium mine, but West Africa's first lithium mine of scale. More jobs, more revenues, more royalties, and the government will be our partner in both of these projects. We enjoy very strong support from them in every aspect. And we're determined to do the right thing by community. We have a strong commitment to Mali first in terms of recruitment. And our workforce at Morila is 97% Malian. That will be replicated as best we can at Goulamina. And I've been to Mali 3 times the last 12 months. Simon Hay, the new MD of Leo's, just been on his first visit. Everything that we've seen on the ground there, encourages us that we've got the right support from government and community. And these 2 world-class deposits can find their place in Mali's well-established mining history. Just a little bit about the demerger. As I said, it's been talked about for quite some time. But there were a number of steps that we had to put in place, consummating that JV with Ganfeng, updating the studies, making that final investment decision. Because to bring this to market, we had to make it clear to the ASX and the other regulators what we were going to do with the funding and map that story out quite definitively. So at the end of the day, we were really only in a position to launch this demerger once that license transfer took place and all those other steps were bedded down at the end of February. So it took us a while to get there, but we're pleased that we launched it now. It creates a platform for 2 independent pure plays, lithium and gold. And from our perspective, the management teams can focus from the Firefinch side. Under my watch, we'll be reviving Morila. Simon will be building this world-class lithium deposit. The ratios and the metrics are all in the paperwork. If there's our shareholders today who want to come and have a chat about any of that, please do. We also have an info line. It's pretty clear that we think there's a great value proposition within both the demerger and the offer that accompanies it. The value split was talked about long and hard, but we're quite comfortable. What we had was the pie of Firefinch's market capitalization at the time. We have ended up dividing that 65-35 X of what Leo we will retain as an investment in Leo, I think most people have got their minds around that. A lot of the analysts have already sort of opined on how they think the relativities of these assets unfold. The timeline's clear. We've launched. The entitlement offer will be live as of next week. Our shareholder vote at the end of May, and then the in-specie distribution, all being well, early June. And Leo will list on the market in mid-June. So this is only the beginning for us. We've demonstrated that we're deal makers, 2 transformational deals in the space of 15 months with the acquisition of Marilla, the JV with Ganfeng. We're going to build and demonstrate the value of both assets before looking to grow, and looking forward to a very exciting future out the other side of the demerger. Thank you.
Thank you, Michael. Thank you, Firefinch. Interesting to see if any of us are smiling next year when you come back to present, if we take on board what you have to say. Right, ready for one last presentation for the day, everyone, before we get you outside to that gold bar. I know this is probably more and more pertinent reason for you to stay than actually coming outside and enjoying a drink for us. One of the things that's been really underpinning some of our presentations today has been that desire, that appetite for EVs, that explosion into EVs and all the minerals that are necessary to make these things go and run. So to help you with some decisions on which may impact on your investment choices is this fellow. His name's Harry Fisher. Harry is a senior battery metals analyst. I bet you didn't think you'd ever be that when you were at high school, Harry. But he's a senior battery metals analyst at RIU. He's based in Brisbane. He's been there for the last 6.5 years, during which time he's covered a variety of commodity markets, given strategic advice to a broad spectrum of clients, and he's part of their battery metals team. And today he is at your disposal. Please make him welcome.
Thank you very much. I know we're very, very close to drinks, but hopefully the next 15 minutes gives you something to chat about over that beer. Thank you for the kind introduction. Yeah, today I will be talking to you about all things batteries. I know there's probably a lot of questions out there, so please come and grab me at the end. I'll just take you through some of the key things that I'm keeping an eye on, and therefore you should be keeping an eye on this year and looking into the outlook. So just a quick introduction to CRU. We're an international business intelligence organization with offices across the world. I'm part of the analysis team, so we do regular subscription products for a variety of commodity types. We've got a consulting business doing bespoke single client work, an events business organizing conferences like this, and recently we've also set up a sustainability division. So I'll kick off talking about EVs because I know that's what everyone really wants to know about. Then look at some of the key themes that we identified at the start of the year, what's changed since then, what we got right, what we probably got a little bit wrong, and then give you some food for thought towards the end. So I think this time last year I was saying how big a year 2020 was for EVs. I think 2021 kind of blew that all out the water. China in particular stormed ahead after having a bit of a weak 2020. And you can see there how quickly EV sales have grown in China in the last year or two. That's also the same's also happened in Western Europe and North America, maybe not to the same extent, but you can see incredibly strong growth rates in all of the major automotive markets. On the right-hand side, you can see EV sales doubled last year alone, and we're expecting them to surpass 10 million this year. So another very strong year. And really setting up very nicely for the mid-2020s and beyond. So just looking a bit further ahead, the EV share increased by another 4% last year, and the same again this year to about 12%. As I said, we'll be getting close to 10, probably just past 10 million units of sales this year. And that you can see that growth rate's not really slowing down. It will continue into the midterm and beyond. And by 2026, we're seeing about 22% penetration. So an additional 17 million of annual sales in 2026 compared to today. In between then, you can see ICEs, so conventional combustion engines start to plateau and fall away as EVs start to take more market share. And increasingly, we'll see more full battery electric share versus plug-in hybrids. So you can see that things are definitely heading in the right direction and gathering pace really by the week. I think one thing that I would highlight here that is a bit of a short-term risk at the moment are the COVID-19 lockdowns in China. So we had about 5.5 million forecast for this year. And given the lockdown situation that's been in Shanghai for the last 4 to 6 weeks now and seems to be ongoing, that is a risk. And I'll touch on later on how important that could be for kind of the whole year, really for the global battery market. So you can see why everybody talks about EVs just from this one chart alone. It's really begun and it's just gaining pace. Since 2017, we've had more than 50% annual growth each year. And over the next 20 years, EV battery demand will increase by more than 10 times. You can see some of those smaller end uses, energy storage that gets a lot of airtime is very important, but it's nowhere near as big as EV demand. The same for portable electronics, laptops, that kind of thing. It's really all about electric vehicles, and that's what I spend a lot of time thinking about. So as I said, at the start of the year, we identified eight themes that we thought were going to be particularly important this year. I'll take you through a few of those and dig into a couple in a bit more detail. Raw materials prices, I think everybody expected that to appear somewhere. We've seen the incredible price performance, particularly for lithium, also for cobalt and nickel in the last really 18 months, but even more so this year. I don't think many of us expected prices to go as high as they have gone, particularly for lithium and nickel, but I think we were right there. Prices are going to remain high, and I'll give you a bit more detail about what we're seeing going ahead as well. This time last year, I was stood up here talking about cathode chemistries in a bit more detail and how LFP was really gaining share in China, and that was a key theme for 2021, the rise of the mini EV models in China. So going forwards, we do continue to see a place for both LFP and NMC to suit different parts of the market. We did think that supply chain constraints were going to ease at the start of this year. That hasn't materialized. This ongoing situation in Ukraine has caused a lot of problems in lots of different supply chains. And also, as I mentioned, the COVID-19 lockdowns in China have also slowed down things a lot in that part of the world. So I think it's going to take a little bit longer for supply chains to ease, even though they've been kind of pretty difficult for 12 or so months. That's particularly acute in the cobalt market, and we're keeping a close eye on that. So I think we were probably wrong on that one. I've talked through EV sales and the importance of those. The next three I've kind of included together because they're all to do with supply chain mapping and the way in which supply chains will structure themselves. And this is something I think is particularly important for the global market, how supply and demand line up and where that sits in the world. I think that'll be particularly relevant to some of the projects here. And then finally, recycling. There was quite a lot of movement in recycling in 2020 and 2021. It's been a bit quieter this year. I think there's been a lot else going on in the first quarter. So there hasn't been as much movement. There's been a few announcements here and there from Glencore and CTT and the like of them. But given that there's not going to be a big wave of recycled material probably until the 2030s, I think we're probably a little bit too early to include that in our 2020 themes. So what's changed since the start of the year? Were we right? And I think I've touched on some of those already. I think prices, they've remained high. I think we were right there, but they've gone a lot higher than I think anyone expected. We do expect them to remain high, but probably adjust down from current levels, which probably doesn't surprise many of us. The prices here in this chart are relative to July 2021. You can see the incredible performance of lithium, particularly in 2022, but really over that whole period. It makes cobalt and nickel look like they've underperformed, but you can still see very strong price growth in those two markets. Obviously, the specifics around nickel are the nickel LME price, and that's very different to the battery chemical price, which is shown on the left. The chart on the right is a bit complicated, but you can basically see that there was a huge spike from the Tsingshan short position in the LME price, but the sulfate price didn't really follow that. There's been a bit of a resistance in the market for prices to go any higher, which we're seeing across the board. Margins are being pressured substantially in the downstream, and buyers are very resistant to pay a lot more. And we've definitely seen that in lithium in the last few weeks. That started to steady a little bit alongside what's happening in China. Over the last few months, with the very high raw materials price position, we have seen that flowing down into the downstream. A number of EV producers have increased their prices, and in the last week or so, we've seen the battery producers' Q1 margins have fallen substantially. So they're really feeling the heat of this, and that is starting to have some tangible effects in the market. So looking ahead, this is all relative to 2021, so it looks quite dramatic, but you just need to kind of think about some of the detail. So lithium prices have obviously risen incredibly high. They'll average 4 times higher this year than they did last year. Cobalt and nickel, again, they look low, but you're still kind of seeing 50% growth on average there. And then looking out to 2025, lithium obviously comes a long way down from the peak this year, but it's still going to remain around 40% above last year's levels. So still very strong lithium prices we're expecting in the midterm, despite them coming off this peak. Cobalt will be up about 50% versus last year, and nickel sulfate around the same level. So overall, you can see the price performance is expected to still be very good, and that's obviously supported by a very strong demand for matic. So now I'll just go into a bit more detail into supply chains and regionalization and why I think it's so important. So you will have seen a lot of announcements in the last 6-12 months from EV producers, battery producers in Europe and North America with very, very ambitious plans for gigafactory build out in those regions. You can see over the next 10 years how much of that growth is coming from Europe and North America, and how the share of global potential battery production will rise from a 20% a couple of years ago to close to 2/3 or more than 2/3 of the market over the next 10 years potentially, and really starting to overtake China. So there's a huge amount of ambition in these regions, particularly in the downstream, and that's obviously supporting very strong growth in the EV sales. But there's not been a lot of movement in the upstream and the midstream. So that's the mining, the refining, precursors, and cathodes. So there's a lot happening downstream, but not so much in the midstream. But why is regionalization important, and why should this be a theme to kind of keep an eye on? You can see how heavily leveraged the whole supply chain is to a number of countries. We've got 40% of lithium supply in South America, 70% of cobalt supply in the DRC alone, and 45% of lithium supply here in Australia, and most of that's in WA. So you can see 3 countries really dictate the lion's share of the entire battery supply chain. All of that then really goes to China, because 70% of the midstream and a lot of the battery production is in China. So again, you're heavily leveraged in one country, and that's obviously not ideal from a security of supply perspective, but it also means these supply chains aren't particularly efficient from a cost perspective. Also from a safety perspective, moving around battery chemicals, precursors, batteries, it makes a lot more sense to have the upstream and the midstream closer to market. So then that material has to then go from China to the major markets in North America and Europe, where, as I said, they're lacking in the upper midstream. So really, we need to start seeing more investment in these regions to support their EV markets, and to prevent them relying solely on China and Asia for all of their battery material. So just a little bit of a kind of an example of what we're seeing in North America. You can see here, this is kind of northeastern US and the border with Canada around the Great Lakes region, and just kind of giving an indication of some of the logistics corridors through that area. If I plot on some of the kind of the key battery supply chain points that I'll reference. Ontario has traditionally been the automotive hub of Canada. It's close to the kind of the major automotive states in the US, so the kind of the geographical proximity there. Quebec's kind of coming into the picture because of its low cost, low emissions energy, a lot of hydroelectric power in Quebec, so we're seeing quite a lot of investment there. So there's quite a good synergy in this part of Canada, and obviously the proximity to the automotive hubs in the US. If you then start looking at some of the recent investments and plans in the region, we're starting to see regionalization happen already. So Electra Battery Materials, they're looking at putting a battery materials park in Ontario with cobalt and nickel sulfate production, recycling eventually, and hopefully some precursor production as well. If you move one step down the supply chain, you've got 2 cathode projects in Bécancour in Quebec, benefiting from the low-cost energy from POSCO BASF JV and also General Motors. One step further down, you've got LG Energy Solutions and Stellantis, who are building out battery production in southern Ontario. And I'm almost done. And then we've got GM, who are making a lot of movements from their existing automotive base in both battery and EV production. So you can see here an example. This is happening in North America around the automotive hub, and we'll increasingly see it in Europe as well. So I know everyone's very keen for a beer, but these are some of the key takeaways I think you should take from today. Please come and ask me if you've got any questions, and I'm always happy to have a chat to you about battery markets. Thank you very much.
Thank you, sir. We could have stayed here for ages. We know genuinely, so go and have a chat with him afterwards, and I'd like to further the conversation with you. Thank you for taking the time for preparing that presentation for us today. Team, go. You're not going to listen to me anymore, are you? But I'll see you here first thing tomorrow morning. No more dogs eating train tickets. Thank you very much. You can rock up whenever you like. We would love to have your company. We'll see you tomorrow morning. Come outside and enjoy a beer on Stewie with us. Thank you.